Welcome to the Property Corner with myself, Rowan Alexander. Welcome back to the Property Corner with myself, Rowan Alexander. In this episode, we're going to be looking at mortgage bonds, how those mortgage repayments are actually broken down between interest and principal, and understanding that process of repaying your bond, what happens when you make additional bond payments, and just helping you understand that repayment schedule better. So because we've been discussing the things like gearing, understanding how to sort of manipulate property investments through gearing, and looking at access bonds, withdrawing some money out of that access bond, reusing it, making additional payments, having money available in advance. I've received a lot of questions about that sort of repayment schedule, how that looks, how much money goes towards the interest, how long you're only paying interest. There's some comments saying on our content saying that in the first 10 years you're only paying interest. And this is sort of something that I've heard a lot. And I want to show you what that schedule actually looks like, that repayment schedule, so you can understand what's happening in the inner workings of your repayments. I've been spending some time looking online at some amortization calculators, and I felt the one that works the best in the South African context is the one from Bond Gallery. So I'm going to be sharing my screen with you so that you can follow my thoughts, and then you can see exactly what the implication is of the changes that we make. So I've set up a loan schedule based off a loan amount of 1 million Rand with a repayment term of 20 years with 12 payments per year. That's obviously your monthly payments at an interest rate of 11.75, which is the current prime interest rate. I've hit calculate, and let's just wait for it to recalculate. And what then comes up is the repayment schedule for this loan. If you have a look at it to understand, the first column, you've got the number of months. The second column, you've got the actual repayment. The third column, how much of that repayment goes towards interest. The fourth column shows how much of that repayment goes towards your capital balance. And then finally, you've got the outstanding loan amount on the far right-hand side. So looking at this, and I think this is maybe where that perception comes from, that initially you're only paying interest. Because if you look at your month one, your loan amount is still very high, and only a very small amount goes towards your principal repayment. So it is true that initially you're only servicing interest. But let's try and fast forward to see what that looks like in the first month of your second year. You can see that balance is already starting to shift, where you're paying less on your interest, more towards your capital, even though your repayments have stayed the same. I'm going to try and fast forward to about 5 years. Looking at month 60, you see your repayment is still the same. You're paying less interest because your capital balance outstanding is less, and you're now paying slightly more towards your loan, more towards your capital. At what point in time does this loan actually reach the point where you're paying equal amounts of interest and capital? I'm going to try and look for it on the schedule. Let's have a look. Somewhere around here. So we're looking at about 165 months. So that would be the period. That's about 14 years in. You're looking at around about there at the time where your interest is equal to your capital installment. That's 558,000 Rand still outstanding. From that point onwards, until the end of the loan, which is 240 months in this instance, you'll see that your interest amount is very low and your capital amount is higher. Up until the point where after 240 months, you have no more outstanding debt. Let's get the cough behind the way. To understand what this then means is that your monthly repayments was 10,321. The total amount you repaid was 2,477,000. and your interest repayment was 1,477,000. So it cost you 1.477 million to lend the R1,000,000 from the bank. Now, this is high, but this is what the cost of interest is. I don't think very many people actually consider what the cost of lending money is. But if you require, or if you need to lend money to purchase property, that's the only way that you can do it. Now we're going to look at the effect of paying additional money into that bond over and above your commitment, to show you what effect that has on the total interest paid over the loan, and also how that actually shortens the loan period. So if you're able to pay, let's use the first example. If you're able to pay 500 Rand extra on your mortgage bond, let's have a look at what effect this has on the repayment schedule. I'm going to shoot straight down to the bottom line to have a look at what effect this has on the time period that it takes you to repay your loan, and also the total interest that you've paid over the loan. So you can see that the loan has been shortened to 206 payments rather than 240. So you've brought down that loan period by about 34 months. Also, your total interest paid over the loan has gone down from 1,447,000 to 1,226,000. So that's a substantial interest repayment saving that you've made. And while you've saved on the amount of interest that you've paid, you're actually also shortening the time. You've saved yourself 34 months worth of repaying 10,000 Rand a month. Okay, so looking at this example where we pay extra 1,000 Rand a month into the bond, we'll go straight down to the bottom line again and have a look at what effect this has. My loan period has now been shortened to 182 months rather than 240 months. So I've saved nearly 60 months worth of repayments. That's 5 years that I've effectively paying my bond off shorter. So I'll now pay my bond over 15 years rather than 20. And the total interest that I've saved amounts to about 400,000 Rand. That's a huge saving and a huge implication. I think this shows why I'm such a big advocate for saving in your mortgage bond and actually using that money on access again, rather than saving in a separate account, because it saves you a lot of money on your interest that you pay over the loan. It can help you shorten that period of time that it takes you to pay your mortgage bond. And if you ever need that money again, it is available on access. So I hope this has been helpful to show you the effect of additional payments on your mortgage loan. And while mortgage finance, or any finance for that matter. So the benefit that you have with a property is that you have the ability to lend this money secured against your home with a long repayment period. If you want to try this out for yourself, go to the bondgallery.co.za and go to the tools section and look for the amortization schedule. This is a really useful tool, and I'd encourage you to use it, even if it's just the motivator to show you how much money you're going to be saving by paying extra into that mortgage bond. I hope you've enjoyed this episode. Stay tuned for more information from myself, Rowan Alexander, on the Property Corner.